People underestimate the risk of standing still, of going with what people expect you to do, to take the safe path in your career, in your life, because that can destroy your health. It can destroy your happiness. It can destroy your ability to succeed, and everything else can come tumbling down because the road that you thought was the safest one was actually the most dangerous one.
Aloha, everybody. Welcome back to the SteadyTrade podcast. Today, it is Stephen Johnson and me, Kim Ann Curtin, who are very fortunate to get to interview author Michele Wucker. She is the author of a book that we both agree, Stephen and I, every trader should read, called You Are What You Risk. But that's not Michele's only book, but we're going to tell you a little bit about her and her other book. She is an author and strategist, and she's famous for the term the Gray Rhino, which speaks to obvious, probable, and impactful risks, which we're surprisingly likely, but not condemned to neglect, but we do have that tendency. She's the author of 4 books, and of course, the bestseller Gray Rhino, How to Recognize and Act on Obvious Dangers We Ignore. China's leadership actually has used to frame and communicate its crackdown on financial risk using her book. This metaphor has moved markets, shaped financial policies, and made headlines around the world. And it's also helped to frame the ignored warnings ahead of COVID-19 pandemic. It also inspired, this is very sexy, this inspired the lyrics of the hit pandemic pop single Blue and Gray by the mega band BTS about depression as a gray rhino. And also Michele's 2019 TED Talk has attracted over 2 million views. It's less than 10 minutes and it's absolutely worth watching. Such a great, succinct explanation of what the gray rhino is in your life. We hear so much about the black swan, but honestly, we don't hear enough about the gray rhino because they are so much more common and we need to be aware of them. But Michele is currently now the founder of Chicago-based strategy firm Gray Rhino and Company. She draws on 3 decades of experience, first as a financial journalist, then a media, and ran her own think tank. She's been honored as Young Global Leader of the World Economic Forum, and now her writing has appeared in pretty much every publication that's important, and she's a sought after media commentator on the COVID pandemic, and I'm just everything you could ever need to have your business be successful. Michele, thanks for being here.
Thanks for inviting me. It's always so great to talk with you.
I am a huge fan of your book. I was fortunate enough to meet Michele recently when I featured her on my podcast, The Wall Street Coach. And I was so impressed with her and her book that I talked to Stephen about having Michele on. And Stephen, in fact, if I understand correctly, has dived quite deep into her book, which does not happen often, Michele. So this is a very impressive moment.
No. I mean, I'm not the biggest reader. I'm not the best reader, but the analogy of the Gray Rhino at the start of the book kind of had me hooked straight away. I think the metaphor kind of had me hooked straight away, and also the arguments between. I didn't realize how important risk was in life, and I didn't quite realize the balance of nature versus nurture, and how risk can kind of change based on our environment. So yeah, it was very interesting. And there's a great story about Aurora, an African guy called Aurora, but we'll get to that later. I'll let you lead with the questions.
Great. I'm so glad you liked it. I learned a lot in the process too, which is, I guess, like why I start the books in the first place, because there's questions I want to figure out for myself.
Well, that's a great place to start. What was it that had you begin this book? What were those questions you were asking yourself?
So, well, You Are What You Risk it really came out of the Gray Rhino, which came out of a very early part in my career when I was writing about the Greek and the Argentinian debt crises. We're both very similar. You look at the numbers and you could see something really big and scary was coming. And both countries had a chance to do something about it. And Argentina ignored a very smart proposal about 9 months before its collapse in 2001. And we saw a big disaster. It took 16 years of legal fights to get out of it. And then Greece in 2011 was in a very similar state. And I looked at it and I'm like, they need to learn from Argentina. So I wrote a paper that got a lot of attention saying Greece needs to do a preemptive restructuring instead of a crazy default.
Wow.
And it was one of the early arguments for a Greek debt restructuring. And in 2012, they actually came to an agreement with their creditors. And it was about that time when I was thinking it's been too long since my last book. And I really wanted to know, what's the difference? They both saw a big scary thing coming at them. One of them did the smart thing, the other one didn't. What makes the difference? And you can apply that to businesses, to individuals, to countries, to just about anything. And I wanted to talk about it in a way that wasn't sort of like geeky policy. As a financial journalist, I wrote about, extremely intricate and complex, sovereign debt restructuring stuff that most people's eyes would glaze over for. And that's not what I wanted to do. Yeah. And so that's when I came up with this idea of the Gray Rhino, this big scary thing coming at you with the horn and 2 tons, and you've got a choice. Like, you let yourself get trampled, you do nothing, or you get out of the way, which is good, or you take the strength of that Gray Rhino and you harness it, which gets you ahead of everybody else. Yeah. And it's gray, actually, that actually came out of, it started with a joke about the black swan, but it's not derivative. The metaphor means something completely different. So this rhino came into my head when I was talking to Fred, an experienced, very senior M&A lawyer. And so I said, like a rhino. He says, oh, you can call it a black rhino. And I went to the zoo when I was in middle school, and I had a faint idea that there actually was a thing called a black rhino, but maybe there was also a white rhino. So I went to Wikipedia, and that's when I realized there was another metaphor that was much better, which is that the black rhinos are actually gray. The things officially called white rhinos are gray. It's like such an obvious thing, but we twist ourselves into pretzels to ignore the obvious thing. So the gray is really the primary purpose of the word gray is to show how easy it is to take our eyes off of the obvious thing. But it's very important to emphasize that we're not condemned to do it. We've got a choice. And we have the elephant in the room that's there for the things that by definition nobody does or says anything about, and that's normal, which is not okay by me. And you have the black swan, which is so improbable and unimaginable that there's not a whole lot you can do other than, have some good reserves and maybe, invest in the author's hedge fund. And, what are you going to do? It's and it helps you to stretch your imagination, but it didn't strike me as very, very useful other than in hindsight as a cop out, which is really how most people have used it. And then you had all these armchair black swan spotters who were actually really talking about gray rhinos. They were things that people were talking about and coming at you. Some of them were more obvious or more probable than others, but it just seemed like there was this yearning for a way to talk about and understand the obvious things that we're more likely to miss than we think. And we needed a framework and a way to deal with them. Yeah. So that's how the Gray Rhino came about. And then we came out in the US in 2016 and China in 2017, and was immediately a big bestseller in China. And when I went to China, this young man comes up to me in Shanghai, wants a selfie and an autograph, and said, "You helped me so much with my life." And that was a big surprise because I'm a policy and finance and business strategy geek, and other readers started doing the same thing. They would write blogs about, their friend dealing with breast cancer, or about job problems. They would tell me about relationships as gray rhinos, or their ill mother, or career choices as gray rhinos. And I just felt this surge of interest, and I took it in a little bit more personal direction after a friend of mine, CEO of a private equity firm, said, all of the investments that went bad for us were things where the warning signs were there, but we didn't look because they were personal. It was the drunk driving, it was the speeding, it was the domestic violence. It was all of that stuff that boards are now paying more attention to in CEOs. And so I took a much more personal turn with this book, but intentionally drawing the connection between personal risk decisions and attitudes and the bigger culture around you, whether it's in your company or in your country or society. And looking in that at a much more psychological and cultural approach to risk, to why some people get out of the way of the gray rhinos and why some of them don't. So the two books really go together, but it really came out of that initial question, you know, why do some people get out of the way and other people see the strength and they use it?
Yeah. Yeah.
So just quickly jump in because it's interesting. Like the thing with the stock market, the way I'd really think about it, and with the audience being aspiring stock market traders, the first thing I think is that there's potentially gray rhinos everywhere, because when you go into the stock market, there's no place that I can think of that has more risk everywhere. But would you say the risk is more specific? Like, I'm just curious, is the risk specifically each trade that you take, or is the risk an external factors that might make you make a mistake in the trade rather than just the risk of the trade itself? Is there more of a surrounding risk, would you say? And how can these day traders work on it or improve? Is there a framework for that?
Well, I think it's all of the above. I think it really depends on your perspective. And what I think day traders and anyone can bring to this is understanding that not every one of us perceives the risks in the same way.
Yeah.
That the way we respond to something, like whether we even see something or not, has to do with our knowledge and our habits, but also with things we probably never even think about, like, you know, our innate personality, what we do to compensate for that innate personality. And when I was writing You Are What You Risk, I discovered all sorts of weird, you know, environmental and neurobiological things. Like if you eat spicy food, your risk preferences are going to go up for a few hours afterwards, like whether you like spicy food or not. And so there's all sorts of stereotypes about people who eat spicy food being risk takers, and there's actually something to that. Or like the fragrance in the air, you know, some of them will make you more risk taking and other ones will make you a little more conservative. Or, you know, the temperature in the room, but it's not even like the exact temperature, it's how you respond to that. I mean, some people hate it when they're cold and other people hate it when it's hot. So, you know, making sure that you're in an environment where you're comfortable and you're not stressed physically or emotionally. So all these things to pay attention to when you're taking decisions, but also how, you know, there are things about particular trades that might set your alarm bells ringing and not somebody else's. And so once you're aware of all these, you know, sort of underground influences that we don't think about, you can actually make better decisions if you create habits and systems and counterbalances to help you to make better decisions.
Yeah.
Let's also talk about the collective. Listen, Stephen, did you see that part where if the group you're with is taking more risk, you will also begin to take more risk because of the influence of the tribe? Talk a little bit about that, Michele.
Sure. Well, social scientists have a term called risky shift, which is that when you're in a group, actually the group is likely as a whole to take either much riskier or much more conservative decisions than, you know, each individual, you know, if you added those up. And from what I see, it's often much towards the greater risk side. And to me, a lot of that comes from something I talk about in the Gray Rhino, which is you know, groupthink and confirmation bias. And that's when you're in a group of people who are very similar. People tend to follow what the first person said. And every person who repeats or reinforces that makes it even harder for anyone to come up with an alternative point of view. There's social pressure to all, you know, say and think and do the same thing, which is why you hear so much about the importance of diverse voices around the table, that you want to really be taking into account other possibilities instead of, you know, just being a lemming going over a cliff. And what's interesting too about this is that it's different in, you know, in different cultures, in different communities, in different groups. I mean, it'll be different in a group that's got a diverse set of people in it from the way it would be in a group where everybody went to school together and, you know, hangs out together all the time and comes from the same place. So there's actually a risk reduction factor that comes from listening to more than one source of information and taking it seriously, having structured debate, and it really, weighing information instead of just going with this sort of emotional peer pressure decision.
And men and women, let's talk a little bit about that, the differences and the misnomers that I myself was under before reading your book.
I love that question, because it's just been fascinating to me. You will hear things about women, you'll hear them about millennials. They're like, oh, they're so risk averse. But I actually avoid the term risk averse because, first of all, it's often applied completely wrong. And it often is applied in a sort of pejorative, negative way.
Yeah.
And or a scolding way, even.
Yeah.
And the definition of risk averse is that that you take less risk, all other things being equal. And the problem is all other things are often not equal. There are situations where women are either punished more than men if they make a mistake in a gender atypical position. Like if they're a police chief and make a bad decision, they're more likely to get fired than a man who made the same mistake in the same position. Or in board or other group situations. I hear a lot about women it needing a lot more effort to actually speak up, because a lot of times people will speak over women and don't want to hear them. So it actually takes a lot more courage and a lot more experience, risk taking, to speak up. So there's certain ways in which women build up that risk muscle better. You may have heard this term heat-heating, which is where a woman says something that's brilliant and nobody pays attention. And 3 minutes later, a guy says the same thing. And everyone's like, oh,
not only have I heard of it, I've lived it,
experienced it, and I actually learned the term from a man, a friend of mine, an expert in risk, who is very much an ally and who stands up against that. But there are ways in which women also will face quantifiably different risks. I mean, if I'm walking down a dark alley at 3 a.m., I'm 5'3.5", and a 6'3" tall guy weighing 200 something odd pounds walks down that same street, it is not the same risk. Yeah. And there's a lot to be said for knowledge and experience. Like the more experience that you have taking risks, the better you are at it, so that the smarter decisions you will make and the better choices that you will make. And there's a lot of research. Julie Nelson, who's an economist at the University of Boston, has done some really interesting research, looked at all of these studies over years saying, oh, women are risk averse. And she said in a lot of cases, the statistical significance was slim to none. So they kind of, pulled out and made a big headline out of something that wasn't really true. And she also said that a lot of those looked at averages. But when you look at the range of risk attitudes, she found a 95% overlap between men and women. So not that different. And, it's very, very interesting to see that we act on those stereotypes in venture capital. That a lot of times women don't get money because the venture capitalists think that they're not going to take big enough risks, when studies show that that's not true, that women startup founders are likely to do better. And, financial advisors will tell women different things. So
yes.
It's
we'll
really
believe different things about ourselves. I think one of the things that really was profound for me with reading your book is when I started my business 14 years ago, I walked away from an incredible salary in finance and really experienced from those around me who probably were not entrepreneurial mindset, that was a huge risk. And all of this time, I have kind of saw myself as, well, I must be a risk taker, or I am somebody who isn't responsible in some way because I decided to take this huge risk. And when I was reading your book, I really got that it wasn't so much that I was irresponsibly risky, but that there really was this place of choice involved. It was a paradigm shift, Michele, reading that part in your book.
I'm so happy to hear that. And I hope that, some of your audience learns, to think about things differently the same way. Similarly, I was in a financial journalism job. I was, running a bureau, and the magazine I was running ended up getting closed down. And so when that happened, I was getting all of these very, very high salary job offers from organizations. And I sat and I looked and I was just like, the risk of tying myself to an organization for my identity, because that's a lot of what it is, and for my professional future, I said, I'd rather go back to, I'd been a freelance writer for a while before that. I said, I really want to go back and have a set of different clients who I can choose for myself, and really do things that I care about doing. And it's a paradigm. And I said that diversification of sources of income is really important. And I actually cite research in the book about the future of work and the increasing percentage of people who are working for themselves, or in smaller companies. And a lot of them think the same thing. They said, we want diverse sources of income because that is less risky than tying yourself to a company that is not going to be loyal to you, or is going to go under. And
yeah. Don't you think that applies, Stephen, to our audience? Like, a lot of day traders are, when they're deciding to do this, or deciding to even create it as a side hustle in the beginning, I think they're being demonized and told, oh, this is so risky, this is gambling. And I feel like a lot of what's spoken to in this book reframes our concept of choices through, again, we have to know our risk profile. But do you know what I mean, Stephen?
Yeah, no, I mean, what I took from it is every situation is totally unique and everything's circumstantial. So, for example, for Aurora, the medical student who came from the immigrant family, who decided to quit medical school to be a stand-up comic. Before reading that book, I would say that guy is mental. He's crazy. He's absolutely nuts. But when you look at his decision in the context of his circumstances and his family and his background, and the fact that he had financial stability and he had a good caring family, and also the context of how and where he grew up, and how his parents' frame of mind were, and how they kind of educated him to say, like, you don't have to have this kind of life if you don't want it. You should ultimately do what the message was a brilliant message. The ultimate message was, if you do what makes you happy, ultimately you'll become a good enough expert that you'll make enough money at it in the end. And that was really heartwarming and touching. So that's what I really took out of the book. It was the fact that if you love what you're doing, that should eliminate a lot of the risk, because you'll have the passion to see it through. Now, you've got to do it sensibly. I mean, and it's all circumstantial and based on context. If you've got no money and you've got 3 kids, do not quit your job and go into day trading, because
Exactly.
It's super risky for you. It's probably going to go wrong. do you know what I mean? It's probably going to go wrong. But it's what I got from the book is it's very circumstantial, it's very contextual, and it's different for each person. So you can't label one person with one brush.
It's true. And I love that you tapped into that whole context of things, because I talk a lot about risk portfolios, like across your life. There are health risks, there are career risks, there are financial risks, there's relationship risks. There are all sorts of different sets of things. And what you want to do is kind of balance out your risks across that portfolio. I mean, for me, a lot of my early decisions were prioritizing my health after having not prioritized it for a long time. When I finally had this aha moment, like, you need to put your health first, and your health is not going to be good unless you're doing something that you feel good about.
Yeah.
And the story of that you were just referring to, he had a family and a set of relationships and supportive people and mentors who, in that part of his life, had a lot of stability and low risk. And that allowed him to take a different kind of risk. And I think people like him, and certainly like me earlier on in my career, underappreciate the risk that comes from staying still and doing what other people expect you to do.
Wow. Can you say that again?
That
was so powerful.
People underestimate the risk of standing still, of going with what people expect you to do, to take the safe path in your career, in your life. because that can destroy your health. It can
Yes.
destroy your happiness. It can destroy your ability to succeed, and everything else can come tumbling down because the road that you thought was the safest one was actually the most dangerous one.
Wow, that is so powerful, especially as a coach, because I will hear people who they come to coaching when that's happened, when that's about to happen, when they've had the heart attacks or the wife who divorces them or the kids that don't talk to them anymore, or whatever. It's like, that is so powerful. And that, I think too, those people probably thought they were not taking risk 10, 20 years ago. They probably thought they were doing what was the least risky. And yet in the end, that's a huge, screws with your mind. I thought I was doing the least risky thing when in actuality, it was the most risky thing. That's just, profound.
Yeah, well, I remember when I was in college, I had friends who they'd go to Europe for the summer, without a plan. They be a bartender for the summer and things like that. And I was so jealous of them because I always had my, 5-year plan, my 10-year plan. I was like, this is how things are going to go. And I really was just so jealous of people who could just dive into an uncertain situation and thrive like that.
Yeah.
Or, for many years, I used to only travel to countries where I knew a decent amount of the language, which meant I spent a lot of time studying languages, and was just in awe of people who would go to a country where they didn't speak the language and, would get along. And it was interesting once I sort of achieved my, my plan of writing my first book before I was 30 and, becoming successful in writing about finance and stuff. I hit that point, and then I went, uh-oh, I don't have another 10-year plan. What am I going to do? Yeah. And that became an opportunity to, to dive into situations where there was a lot more uncertainty. And in hindsight, I look back and I see some of the decisions I made as having been risky, by other people's standards. I finished college and I went off to live in the Dominican Republic. Doing things that seemed to me like the clear decision that were part of my plan, but that other people might have thought were risky. And so in hindsight, I realized that I was taking more risks, so to speak, than I had really given myself credit for. And I think that prepared me to be, an entrepreneur later on in life.
It's definitely how you prepare for it. And there was a good example of how you prepare for risk in the book where you related it to a race car driver. Like a race car driver racing really fast, he's less likely to make a mistake under the pressure. So is there any kind of comparison of if people in finance or day traders who are always exposed to risk, is there a way to limit that other than just constantly being exposed in the environment?
Well, it's interesting. I often describe risk as being sort of like the Schrodinger's cat, that the very act of observing it objectively changes the nature of the risk, because when you're aware of it, you're more likely, not always, unfortunately, but you're more likely to put into place plans for pivoting if you need to. There's a lot of research that shows the more knowledge that you have about a situation, the more comfortable you're going to be taking a risk. And that becomes kind of emotional because there are some people who might actually perceive the risk more accurately, even though they don't have the information, because that information gives you kind of a bias in favor of thinking that you know what you're doing and you can control it. So you got to be a little bit careful. But for day traders, particularly for people who are just starting out, I think studying history, the history of booms and crashes is really instrumental. Charles Kindleberger is someone whose work has really influenced me over the years. His book, Manias, Panics, and Financial Crises, who talks about these volatility cycles, or Michael Pattis, his book, The Volatility Machine, which is, like 20 something years old now. But first of all, to be aware of how important central bank policy is to what's going on. When I finished graduate school, I started out as a writer for Dow Jones. We were writing about all the restructured debt from the 1980s, and it was just, people were just piling that stuff on. And I would be interviewing these, 25-year-old guys who didn't speak Spanish, but who I was supposed to ask what they thought about the, political and social and economic conditions in these countries who are actually, did speak Spanish and like knew the finance minister personally. And so there was a lot of bravado, and there were also a lot of people who would come up with these arguments as to why this was just going to keep going up forever. And I see a lot of similarities to what's going on today. I also hear a lot about the democratization of finance, and I do very much believe in financial inclusion, that a much broader set of people should have access to the benefits of rising markets. But I also look back at the last time I heard a lot about democratization of finance, which was in 2000, not too long before the dot-com crash. And all my journalist friends were getting hired away from one financial site to another. And I remember one of them went to a site whose mission was the democratization of finance in Latin America. And, a little understanding of what happened in 2000 shows how dangerous that was. And I also have seen some research showing that a surge in retail investment happens right before a crash. I look back at, say, like the mortgage-backed securities as sort of the 2007-8 crisis, that there've been a huge in securitization and asset-backed securities during the beginning of the 2000s, and that basically spread the risk among a lot more people, a lot more smaller people. And so like the big guys had been, chopping up the risk and spreading it out. And so when things went bad, the big guys got bailed out by the government, and the the little guys didn't. So I think it's important to be aware of the risks and go back to that risk portfolio across your life, but also in your finances model. A friend of mine told me recently about a 25-year-old woman who had like $50,000 in savings, and she put half of it into GameStop, and my heart almost stopped. I call it heart stop trade. There's this sort of feeling of masters of the universe. We can do anything while prices are going up. That's there, and you want to write as much of it, write as much up as you can. There's that sort of FOMO feeling if you don't, but also realize that you should also have a set of more stable investments and in parts of your life that really make sure that that if you're taking on big risks, which day trading is, make sure you've got the safety net and the backstop for when things go wrong, because there will be a when. It's not an if. I mean, you understand financial history enough, and you see that. So, and don't get me wrong, I'm not saying don't day trade, but an awareness of the risk and the kinds of things that you can do to protect yourself are just hugely important.
Yeah, no, just to end on that, it's funny because there's some famous quotes as well, but the most dangerous time to invest is when everyone's investing at the peak of a bull market, when prices keep on going higher. And the actual more the safest times to invest is after it's crashed and everyone thinks it's dangerous. So it's quite funny how that works out, but no one follows it.
Yeah, and I think what you want to do is look at some of the contrarian indicators. I mean, if you're seeing this extreme greed, then maybe you want to be a little bit more cautious. Look at margin debt. How many people are borrowing to buy shares? Look at short interest. How many people are borrowing shares hoping to hoping to sell them short and make a bundle of money that way. Be really careful about it. And I think also one of the things I learned early on in my career in finance was that good economic news often is bad for the financial markets, because people are looking so closely at interest rates and what the central bank is going to do. And you see right now a lot of concern over inflation and over when the Fed is going to start raising rates. And even before that, to stop buying financial assets, which it's still doing it. It's sending out the messages like, no guys, keep going, but people don't have a lot of confidence that that's going to go on forever, because at some point that additional liquidity it's not going to have the economic benefits. You get decreasing marginal returns, as we say in geek land. Basically, you stop getting as much bang for your buck, the longer you do it. And at some point, that's going to mean that companies are going to have absolutely no way of meeting these crazy inflated earnings expectations. And the whole house of cards is going to come down.
Scary
Not to be Debbie Downer or anything, but
no, but it's reality. I mean, this is just the reality, and I think it's important that those who listen to us, consider this, because it helps them be prepared. Like I love the phrase "gird your loins," like be prepared. Did you have a question, Stephen?
No. I mean, just to counter to what you're saying, I think with day trading, I always say it is okay, because we're in stocks for 5 minutes, 10 minutes, 20 minutes. If the market goes bearish, you should stop trading, or you should go short. So, and if you're going long, you should stop. And for us, and where it's specifically in market cap, micro cap, there's just no runners. When the market goes bearish, there's just nothing to trade. So we kind of just, is it preempt? We're kind of not protected, but there's less risk. Is investing.
Having a good sense, like you talk about, what are the things that are going to make you step back? And those could be the market conditions. I mean, I find that people look so much at what's happening in the market or in the news or headlines, things that are outside of them. But one of the messages I hope that people will take from the book is that you need to take a look at yourself as well. Are you super hyped up and anxious and nervous? Are you getting enough exercise? How's your health? Are you drinking too much caffeine? How is that going to affect what you're doing? So you should have similar, personal triggers for stepping back if you need to. And what's been interesting for me is making a shift from early in my career. I wrote about market shift from minute to minute. I put out a story about the latest progress in the restructuring of a bond, and I would look at my screen. This was the very, very early days when you first had real-time prices on these like clunky teller rate terminals. It was like green letters and numbers, and I would see the numbers go up. Like, oh wow, I wrote that story, and like $1 billion just got created. And the opposite on the other side, and there was this kind of like adrenaline rush from that, and it was really interesting seeing that impact on the markets. But at some point, I made a conscious decision to actually step back from day-to-day market stuff, because that adrenaline at some point gets to the point where like you need more and more and more and more of it. Just like quantitative easing. At some point it does not help, and it hurts. Similar, even before that in my career as a journalist, I was writing about the serial killer Jeffrey Dahmer and police news and crises and things. And it got to the point where I was always feeling like I needed more and more and more, and had to make a conscious decision to step back, because it's like a sugar high. And at some point, are you going to day trade forever? Why are you day trading? What are you going to do with the proceeds? Are you just going to put it in and make more? Well, why? What are you making that money for? And what's that going to do? And what's going to happen when you hit that point where the adrenaline high isn't enough anymore?
That's an important question.
This is something that everyone struggles with, though, and we've had other guests on. We've had hedge fund guys on who, I remember one hedge fund guy, and he said he'd been trying to make more and more and more and more money, and he'd got to the point where he was lying on his sofa depressed, and he was listening to a repeated voice note of his bank balance and his phone saying, in your bank you've got 1.4 million. He was lying there depressed, saying, if only it was like 2.4, I'd be happy. And it's the story of life, and it's the story of every day trader. If I can just get here, I'll be happy.
Turning Duff, who wrote the buy side, talked about that, and that's when he realized, wow, I have a situation. I have a situation here.
And it gets even scarier, like if you have a relationship or God forbid, kids, and what sort of example are you setting? And I talked about how important it is to understand, your own relationship with risk, and what I call your risk fingerprint. The choices that you make and what goes into that, whether it's your innate personality, the experiences that you've had that make you either, gun shy or trigger happy, and the environment, everything around you. But it's important also to show risk empathy, particularly if you're in a relationship.
Yeah, talk about
there are
that.
yeah, there are lots of situations where there's, opposites attract. One
Yeah.
person is more, let's go get them, and the other person is kind of pulling you back from the ledge. But think about how your behavior affects that relationship and how your risk fingerprints either complement each other or clash. There are some examples in the book of people making risk decisions based on the people in their lives. After the Ethiopian Airlines crash, the 737 Max, there's an airline, tourism journalist who wrote about it. He was actually booked on one of those planes before it was grounded. He was booked to go home. And he had, read all the reports and interviewed people. Like I was saying, knowledge can make you feel like you have more control, but sometimes can be too much. But his family was flipping out. They just couldn't deal with it. And he said, I'm going to switch the flight to a different aircraft because I don't want to freak out the people around me. And that comes down to like when you're going to the airport, the kinds of professional risks that you take, the kinds of physical risks. There are some things that you do to change your risk behavior because of the people around you, because you've prioritized the risk to that relationship and to the well-being of the people who you love. And my guess is that for a lot of day traders, particularly with the adrenaline rush that we were talking about, if you don't prioritize those other things, it's going to come back and bite you. I was raised, and I'm sure a lot of other people were too, that you put the work first. There wasn't day trading back then, but you put your job first, you put your day trading, you put all that stuff first, and everything else you just let slide, because otherwise you're not going to be quote unquote successful. And there's so much more understanding now. And even, you telling your story, walking away from the, from the nice Wall Street salary, I think there's a lot more understanding that professional success, the money in your bank account, is only part of the story. And if the things outside of that you really care about go bad, it's also going to affect your professional success.
For sure. The other thing that I was really struck by, I'm a huge fan of Geert Hofstede. Am I pronouncing his name right? He has had a huge impact, especially because of the clients I've worked with over the years, coaching different cultures within organizations. And that was something that I used often. I had one client who had been raised in Korea, South Korea, and American, but Frenchman in New York City. And this was somebody that he really wanted to promote, but felt that she wasn't confident enough. But of course, the way a woman raised in that culture shows confidence is different than the way he experienced it. So talk a little bit about the cultural impact as well, because one of the things he taught me, Hofstede, was that culture doesn't just happen if you're born in a country. It happens with the parents that are raising you and their culture, regardless of where you are located when you're being raised.
Absolutely. And there's so many stereotypes too about different cultures. One of my points is that sometimes people will apply stereotypes to the decisions they make about whether they're going to promote someone or not, or invest in someone. And that sometimes will internalize those. There are times when a woman might be actually much more comfortable with risk, but is expected to step back. So might actually behave in a way that's expected of her rather than what feels right. And that's very dangerous. I was fascinated by the differences among countries in their risk responses. And part of it came from the reaction to the Gray Rhino. When it came out in China, it was just, boom, bestseller right away, very influential. And people really know what's going on there. And then in the United States, people kept saying, oh, Black Swan is the thing. It's the Black Swan. And, I got a lot of pushback here and a lot of defensiveness when I said, hey, we're not paying attention to obvious things. Whereas they totally got it in Asia. They said, you gave us a way to talk about what we were worried about in the first place. And I found that there are lots of stereotypes about other cultures. I cite some of the research on, Chinese versus American students who were asked to make some financial decisions. Whether you would rather get 4% definitely, or something that varies between 0% and 8%, the second of which is more risky. And they both thought that the Americans would be more, risky.
Wow.
And the preferences actually came out very similarly. And everybody was surprised by that. So the researchers went back and asked, okay, how risky do you actually see this?
Yeah. Yeah.
How risky do you see each one of these things? And what was very interesting actually was that the Asians saw the same decision as being less risky. So they technically were taking less risk
Wow.
than the Americans were. And so it's like a room of funhouse
Yeah.
mirrors.
Yeah. Yeah.
You don't see risk the same way. And there's a lot of research I talk about in the book comparing collectivist versus individualist cultures, and this sort of individual to risky shift in groups. That phenomenon is different. The gender stereotyping is different, depending on the underlying culture. They compared Koreans more collectivist with Australians more individualist. And it was absolutely fascinating to see that a lot of the things that we think about other cultures are not true, particularly in the situation. Another thing I found is that Lloyd's Register Foundation has been doing a world risk poll, looking at how much of a certain risk a country experiences versus how much they worry about it.
Oh,
That's
interesting.
all over the place, very, very different. I just did an interview with a Korean newspaper where they looked at it. I said, wow, Koreans are, very big on the worry side.
Wow.
And that's very interesting. There's another thing that Ipsos does. Looks around the world at, they calculate the empirical probabilities of, that you'll die by gunshot or all sorts of other things, that there is some sort of, history that you can compare to and create a, ballpark estimate of probabilities. And and then they surveyed people in these countries and asked them, okay, what do you think the chances are of this happening? And then they compared it. They call it their misperceptions index. And that also was all over the place. And often the countries that were more confident in their responses were actually the most wrong, which
Wow.
goes back to the psychology of your own reaction. The
Yeah.
more confident you think you are, the more you probably need a pulse check, because there's a correlation between overconfidence and bad risk taking.
Wow. That's a pretty powerful last sentence. What do you, don't you think,
no,
Stephen?
just to add to that, I mean, traders take the biggest losses on the hottest streaks. You get more and more confident. It's all going well. There's some sort of distortion field that goes out of control, and then you'll just take a crazy loss and look back and think, how on earth did I get here? So yeah.
It's true. Well, there's some research also showing that the more you see is in it for you, the less risky something will appear to you. And so
Say that
you need to
again?
correct for that. The more you see is in it for you, the
more
less
you
risky you
see
will see
is in
that.
it for you.
The more benefit you see.
Okay.
The more you see yourself benefiting from a particular decision, the less risky you're going to perceive it to be.
Yeah.
Wow.
And of course, there are two
so
aspects to risk. There's the how you perceive it and how much you're willing to take on. And I think that confidence also affects how much risk you're willing to take on. So, you're seeing it as less risky and you're willing to take on more. So that creates a bigger and bigger gap between reality and not. So just being aware of those biases, in super forecasting, there are, they ask you, if you want to become a super forecaster, the early tests ask you both about your prediction for the percentage probability that something is going to happen by a particular date and your confidence about it. And what I found about doing those was it's the Good Judgment Project, actually, is the name of the project, Philip Tetlock. But the more I paid attention to how confident I was, the better my projections got. So that's another thing that you really want to take a pulse check on. Look at your trade, say, okay, how confident am I that this is going to go up X% by Y date? And then track it in hindsight. But track your confidence level at the time you made the trade. And when you start going back and seeing that pattern, the gap between your confidence and whether it turned out or not, that can give you a lot of really powerful clues into yourself and the trades that you make. And if you listen to it, it can improve your trading behavior going forward.
Track your confidence. That's so powerful.
Yeah.
I would be very curious how that's going to unfold, Stephen. Track your confidence. We taught, I've advocated tracking the emotions that are going on for you to look at over time what emotionally is your state, but I've never considered tracking the confidence. That is really, really interesting. I'm a baby trader. I'm just still learning. And my first trade was a trade on Mara, and I made 20%. It was a swing trade over Martin Luther King weekend. And Bryce is one of the holding my hands through this trade. And he Tuesday morning said to me, "What do you want to do, Kim? Do you want to, you're up 20%. Do you want to hold on to it, or let go?" And instantly I felt the greedy side of me, like, I want more. But I noticed that I want more. And I was like, whoa, this is not good. I'm not neutral anymore. So I sold it because I thought, but I'm curious now though, if that was confidence, maybe at first it was just that feeling of like, greed. It was just insatiable, a feeling of insatiability. And I thought, oh, I'm in danger now.
Being aware of that emotion is so important. It's like the Schrodinger's cat, observing it actually changes things. When you're aware of your emotions, you can do things, take a deep breath or go for a walk or do whatever it takes to bring yourself into equilibrium. And actually the tracking itself can help you feel very, very confident. I talked about writing for Dow Jones early on in my career, right after graduate school. And so I was, doing this sort of intense, market reporting all day long. I had a long commute from Harlem to Jersey City. I was at the tail end of a relationship that probably should have ended, a long time earlier. And on nights and weekends, I was writing my first book. And one day I woke up and I started crying, and I had absolutely no reason why. Now, having told you all this, it's probably pretty apparent to you. So I found this really great cognitive behavioral therapist to work on stress management. And one of the things that she had me do was at the beginning of every day, when I sit down at my desk, rate how stressed I feel. Do that, a few times a day. But with that, say, okay, what's contributing to this? What are the stressors? And then track what you're doing about it. And I swear, just the tracking itself made a huge, huge, huge dent in how stressed I was. And tracking of all of this stuff both gives you a sense of control and knowledge. And if you apply that knowledge, it can make you so much more powerful.
Yeah, agreed. And
I think it's not even just being stressed though. I think if you're in a bad mood or a good mood as well, it's just asking yourself why am I in a bad mood? Because there's got to be some sort of trigger or a reason, right? A lot of the time there is. And if you close your eyes and think and go a little bit within, you'll find the reason. And if you just apply the same CBT technique,
for sure,
then it's gonna be powerful in the same way as well.
And I think traders, that we have in our audience, they are under a lot of pressure. I mean, life right now, especially after this pandemic, we're still in the midst of this pandemic, has been stressful for everybody. And I feel that sometimes we have these unreasonable expectations of, a lot of times what I hear some day traders say is, I have to make this work, Kim. I have to make this work. And I'm like, that energy of having that self gun to your head, that's not helping you. It's not helping you.
If you're feeling I have to make this work, step back and And just give yourself all the space that you need, because that is likely to lead to a bad risk decision.
It's going to sabotage the very thing you want to create for yourself. Like, come from choice, but if you're coming from have to, then you're potentially just increasing all the strikes against you that are naturally occurring, because this is a challenging place to be.
I don't know if a better question is maybe just saying, as long as I commit myself and give 100%, there should be no reason why I would fail. I mean, maybe that's a better way to frame it, because that's how I always thought. It took about 4 years to get profitable, 3 to 4 years to get profitable. And it was just like, as long as I do the work, there's no way it's not going to work. I'm going to get it.
Yeah, but you also set yourself up to have, I think, that success because you had other revenue streams.
You have to work hard. No, I had a good job in Dubai in advertising. I saved a bunch of money. Like, I made sure that there was no danger. There was no concern. There was no worry when I left. Yeah. And I had good freelance contacts for advertising still. So
would you say that that's part of mitigating risk, Michele? Just those factors that Stephen created for himself, that mitigated his risk even as he stepped into something quote unquote risky?
Yeah, I think it goes back to this whole risk portfolio idea that, if you've got the financial cushion, if you've got people around you who support you, if you have the right education and the right skills, if you really do your homework. There's some research about entrepreneurs who we stereotype as being, risk seekers, but they actually, the evidence shows that's not necessarily true. It's often that they do more research, and they also have more confidence than they're going to succeed. And that of course comes down to your judgment, and you might want to do a little informal survey of the people around you about how good your judgment is, because because there are times you can be absolutely convinced you're doing the right thing, and that confidence is not going to save you if you just made a really bad decision from the outset.
So for example,
it's, also it's a question of choice, that some people have the choice to do that, and risk and choice are so closely intertwined. And so, the trader who's saying, I have to do this, they don't feel they have a choice, but they actually do. And once they step back and say, okay, riskier than what's the choice between, that changes the dynamic of the conversation. And, keeping a goal in mind and tracking your progress towards that goal. I mean, it's one thing to take a few years to be profitable if you are, consistently making good decisions. But if like all of your decisions are really, really, really bad, then maybe not sticking with it for 3 or 4 years is the best idea. Of course, you run out of your runway anyway.
And talking about sad stories, what happened to Edson Taylor in Niagara Falls? What went wrong with her from your point of view?
So, this is the story that I started the book with. So Annie Edson Taylor was she was 63, and she'd been reasonably well off, had sort of an adventurous life, taught all across the country in Mexico, but she was kind of, she'd run out of her money, and she was looking for a way to to make money quickly and honestly, and she decided that she was going to become the first person to go over Niagara Falls in a barrel. And so she did a lot of things to mitigate risk. And she also was someone whose personality and experiences, like having had a cushion, had really primed her for risk taking. So that innate personality and experiences went into it. And then she went and she souped up this pickle barrel to, she patted it and put in things to hold on to. And she tested it. She sent her beloved cat over the falls. And I saw a picture of her with the cat and the barrel, which I hope was taken after she went over. From what I understand, the cat did survive. And, she postponed it by a day because it was too windy. And, she went over, she survived. And that was great. But she'd planned on making this into a career, like as a speaker. And she had failed to take into account a couple of things. First of all, that her speaking was not nearly as dynamic or interesting as her life. I'm being very polite from the accounts that I read. So that was just not a career option. And the other part was that when they did the media interviews, they'd said she was 20 years younger than she was. And the promoter or manager she had hired actually found a woman who was the age that she thought that she was, and they stole a pickle barrel and went touring around with that other woman. So, poor Annie Edson Taylor, sold tchotchkes and little things, but she didn't have this big get rich quick result of her trip over the falls, which was kind of sad.
It is
But
sad.
she's gone down in history books.
But the evidence of how she mitigated for all this risk, took this crazy, life-threatening opportunity, and yet the risk of betrayal, the risk of I don't actually know how to be a good speaker, is not a place she looked. So that perhaps, again, that sense of the blind spots, be aware that we could be mitigating all the risk over here, and yet is there another risk behind us out of sight that is what's going to take us down?
And people are fascinated by those. And, I think we'd like to believe that if something went wrong, it was something that we didn't see, because it's not our fault then. But there are things that you can do to make sure that you're better at seeing some of those things, getting the diverse sources of information, having your personal board of directors, the people around you who, your financial advisor, your lawyer, your doctor, your coach, your chatty best friend, the Aquafina character in Crazy Rich Asians, the people who will tell you the things that you don't really want to hear. And did she have someone in her life who would say, hey, this manager guy is a shyster?
Yeah, exactly.
And maybe you should, well, I guess she didn't have anything really to speak about before that, but she'd been a teacher for years. She had to have some, presentation ability.
Yeah, she could have just been distracted by trying to pad the pickle barrel and keep herself safe. Like that became.
And she did a great job of that.
Yeah, she did, right? But it's just, you got to make sure that you have that big picture perspective of risk. Do you have another question, Stephen, or should I bring it home?
That was the last one. Bring it home.
Okay, so Michele, we could talk to you for another hour. I find this fascinating. I'm paying attention to risk, my own risk fingerprint for the first time in a really conscious way. So thank you for that. And thank you for this conversation. I am curious what our listeners will have to say about this. Please put your comments in the bottom of our YouTube channel, because we do read them. And we're always looking to make sure that we bring guests here that you like. I hope you like Michele and her book as much as I did. And we'll see you on the next SteadyTrade podcast. Stephen Johnson and I say aloha for now.